Good morning, class. I trust you are doing well. Let's have a look at input tax with regards to VAT. Now you'll see input tax is the VAT component of the payment for goods and services applied to the vendor. Remember, when we were doing output tax, we were selling goods, and when we are selling goods, we need to levy output tax. So input tax works where I am purchasing something, where I am buying a good or a service, and by doing that I am able to claim input tax on that that good or that service. Alright, and a vendor who purchases, for example, stationery to be used in the making of taxable supplies can claim the VAT part of the expense as input tax. So I'm going to explain it with regards to the example at the bottom, but in simple layman's terms, all I need to do is basically have a look at the example here at the bottom, and maybe it's easier if I just do it this way. So a vendor who only makes taxable supplies, purchaser limited, acquired the following goods from vendors during the tax period. So he acquired a computer and stationery. Now you'll see that both of those amounts are VAT inclusive. So in other words, we need to calculate the VAT, because what are we doing at the end of the day with regards to VAT? When I am going to be doing the VAT of a customer or of rather a client, what I need to do is a VAT return. So that means I need to calculate all of my output tax minus all of my input tax, and I will either get a amount that I need to pay over to SARS if my output is more than my input, or I will get an amount that SARS needs to pay me back where my input is more than my output tax. Alright, so let's have a look here at what they did. So it works in the same way as the output tax, only difference being this is on the input side. Alright, so I am able to claim the VAT back from SARS. Remember, we as a VAT vendor are acting as the middleman, so between SARS and the consumer. Right, so very simple. I multiply the tax fraction by the amount, VAT inclusive amount, and I get my input tax. So I'll get the total amount of input tax, and I will then deduct that from the output that I've calculated. Alright, so what is the definition of input tax? So Section 17 of the VAT Act provides that where goods or services are used partly for making or for the purpose of making taxable supplies, only the portion of the input tax attributable to taxable supplies may be claimed as an input tax credit. Now you'll remember in class that I said you cannot really apportion output tax. The only thing that I can apportion for output tax would be fringe benefits and indemnity payments. Now for input tax it's different, because I have to apportion the input tax with regards to the amount of taxable supplies that I am making. Now we'll get to how do I calculate this, but basically if I have taxable supplies, more than 95% of purchased goods or services are taxable, are used in the purpose of making taxable supplies, the full input tax credit may be claimed and no apportionment is necessary. Alright, so 95% is basically the minimum amount of taxable supplies that I need in order to be able to claim 100% input tax. And this is what we call the de minimis rule. Right, you can have a look here. I think it's easier to just, if you want to pause the video, you can pause it, have a look at all of the documentary requirements that I need for input tax in order to claim input tax. If goods or services are purchased from a person who is not a registered vendor, I cannot claim input tax. That's a very important thing to recognize with regards to input tax. I can't claim input tax because there has no VAT has been paid on the goods or services. The only exception is the purchase of second-hand goods from non-vendors. Alright, we will also get to a bit later. Input tax should usually be deducted in the VAT return in the period during which the time of supply occurs. Alright, So this is going to be usually, remember for VAT we've got different categories of VAT vendors, and we've got different times or VAT periods in which those categories of VAT vendors fall. So it can either be for a month or 2-month period, whatever category the vendor falls into. Alright, so input tax should usually be deducted in the VAT return in the period during which the time of supply occurs, or for imported goods, the period during which the goods are released in terms of the Customs and Excise Act. Okay, very important here, going forward, that you make sure that there are tax invoices, because tax invoices are the driving force behind the VAT system. I cannot claim any input tax and I cannot levy any output tax if I don't have a tax invoice, because I need to provide SARS with documentary proof. No input tax may be claimed unless a vendor is in possession of a tax invoice. Okay, so a registered vendor is obliged to issue a tax invoice only if the total consideration of the supply exceeds 50 Rand. A supplier or the agent of a supplier must furnish a recipient with a tax invoice within 21 days. So this is all, again, a lot of requirements that I need to just have a look at. And I would say maybe it's better if you have a look at these requirements in your textbook. Okay, so how do I determine input tax? So input tax is the VAT component of the payment for goods and services supplied to the vendor for the purpose of making taxable supplies. And what is input tax defined as? It is defined as the tax payable in terms of Section 7 by a vendor to a supplier on the supply of goods or services by the supplier to the vendor, on the importation of goods by the vendor, or an amount equal to the tax fraction of the lesser of any consideration paid in money, open market value of the supply by way of the acquisition of second-hand goods situated in South Africa by a resident of South Africa. Alright, very long definition. It's really not that difficult. If we're going to break it down into its separate components, you're going to see it's not difficult at all. Alright, so what are the first two components of the input tax definition? Because it relates to VAT that was paid by the vendor when acquiring goods or services and importing goods. So when goods or services are acquired from a vendor, VAT will be paid and a tax invoice will be supplied. So when goods are imported, you remember when we had imported goods, we had to pay output VAT. We had to pay output VAT on that importation of goods over to customs, right? Because customs was then the middleman between us and SARS. And that amount can sometimes be claimed as input tax by a vendor. So in other words, I paid the output tax, but I can then immediately claim it back as an input because I am a VAT vendor. So VAT can be claimed as an input tax deduction only if VAT was paid by the vendor at the standard rate, or in certain circumstances also on the purchase of second-hand goods. That is a notional or deemed input tax deduction. We will get to that. No VAT may be claimed if the vendor does not have a valid tax invoice or the required documentation to claim a notional input tax deduction. Okay, so how do I determine the input tax? It's important to determine the purpose for which the goods or services acquired will be used, and this is very important for input tax because this will determine the amount of input tax that I can claim. If I use the goods or services wholly in the course of making taxable supplies, then the vendor would be entitled to claim the full input tax. But if a vendor uses the goods or services only partly in the course of making taxable supplies, either of the following input tax deductions may be made. So if I've got more than 95% taxable supplies, I can claim the full input tax deduction. But if the portion that relates to taxable supplies is less than 95%, I need to apportion it. So let's say, for instance, I make 70% taxable supplies and 30% exempt supplies. I will only be able to claim 70% of that input tax. Alright, so apportionment of input tax is therefore compulsory where goods or services are acquired for both taxable and exempt supplies. But output tax is not apportioned, except for fringe benefits and indemnity payments, as we've said before. Okay, so probably the easiest way to determine this way of apportioning is to use the turnover based method. Alright, I'm not going to go through this formula. I think pause the video, have a look, read through it, see exactly what it is, what needs to be included for each of those components, and then we'll continue on the next slide. Okay, so the amounts used in the above calc should exclude VAT. Very important. I cannot use VAT inclusive amounts, because value referring to an amount that excludes VAT. Okay, and the percentage of taxable use should be rounded off to 2 decimal places. Okay. This percentage that we're trying to calculate, we can only calculate it once a year, and the same percentage is used for all the inputs of that specific year. Alright, SARS states that the following amounts must also be excluded from the calculation: supplies of capital goods and services acquired for the use in the enterprise, supplies of goods and services for which the input tax credit is denied. Okay, let's quickly have a look at this, example. Very important. I think pause the video as well, read through it properly. It's no use for me just reading it. Okay, so if we read through this quickly, we immediately saw that there's letting activities of residential properties, which is exempt for VAT purposes, and we have a normal manufacturing process, which is taxable supplies. Alright, and there's two things that the VAT vendor purchased: a new computer and a new mixer, and he wants to determine what part of it is going to be what he's going to be able to claim for input tax. Alright, so basically all that they did here, and you will see there in the calculation at the bottom, we first used the computer as an example. Total amount of input tax that we had to use was the 22,800 times the tax fraction. Total value of taxable supplies was 200,000, because that is the amount of supplies made from manufacturing the potato chips, and the value of all supplies is going to be the taxable supplies and the exempt supplies put together. So we will be able to calculate a percentage. And it's maybe easier if you use a 200 over 375, calculate a percentage, and then multiply that by the amount of input tax that they are able to claim. Alright. So, if we go on further, what is denied for input tax? What type of things are denied for input tax? What can't I claim as input tax deductions? Alright, so the input tax is denied on goods and services acquired to the extent that such goods and services are acquired for the purposes of entertainment. I cannot claim input tax on entertainment. So in other words, if I take clients out for dinner, I'm not able to claim input tax on that expense. Okay, so this includes provision of food, beverages, accommodation, entertainment, amusement, recreation, or hospitality of any kind, etc., etc. Okay, in respect of entertainment expenses, these are cases where the input tax will not be denied, these being vendors in the business of supplying entertainment. So if it's your business to entertain people, as long as a charge is made by the vendor for the entertainment and the charge covers all direct and indirect costs, or the charge is equal to the open market value of the entertainment supplied. Vendors in the business of supplying entertainment, if the entertainment is supplied for bona fide promotional purposes, so to current customers, and any excess food not consumed by the customers during a taxable supply is subsequently given to any employee or any welfare organization. I think it's pretty obvious, and I think you can maybe read through it. A vendor supplying entertainment to an employee or connected person, and a charge is made to such person that covers all direct and indirect costs of such entertainment. Any meal, refreshment, accommodation of a vendor, his employees, or any self-employed natural person who is required to be away from his usual place of residence for at least one night. And then lastly, a self-employed person is a person who is not an employee of the vendor but who invoices the vendor for services rendered. A vendor may only claim the input tax on the personal subsistence or self-employed natural person, where the self-employed natural person is by reason of his contractual obligations with the vendor obliged to spend any night away from his usual place of residence and usual place of business.